Welcome to the Note Nuggets podcast, where you can learn how to become the bank, build wealth, and accumulate streams of income perfect for your savings or IRAs. You'll hear from industry experts, seasoned veterans, and everyday investors. Our goal is to teach you how to invest in notes, one nugget of knowledge at a time. Here's your host, Kevin Galang.
Welcome, everybody, to another episode of the Note Nuggets podcast, where you can learn how to turn other people's debt into income for your savings or IRA. Recently, on my other investing podcast, Tech Guys Who Invest, my co-host Adam Mueller and I talked about the disadvantages of our respective asset classes. He talked about the disadvantages of investing in multifamily properties, while I shared the disadvantages of investing in notes. If you want to check out that episode, head over to tgwipodcast.com/disadvantages. This episode inspired me to ask the questions: who is note investing right for? And what type of investor would be ideal for notes? Not to be cheeky, but of course I believe that notes should be a part of every investor's portfolio. In all seriousness though, I wanted to provide some things to think about if you're interested in note investing. One of the advantages of note investing is that you don't have to worry about maintenance or repairs at all. You don't own the property. You own the debt the borrower used to finance the purchase of the home that they own. Because the borrower owns that property, that responsibility of maintenance, repairs, all falls on them. That responsibility is theirs. With rentals, you have to worry about tenant turnover. It's expected. In fact, if you're a landlord, you've likely already accounted for vacancy rates. But with a mortgage, the borrower is less likely to leave unless they sell the property, which would pay you anyway, because they would take the sales price of the property, pay off the mortgage, and then whatever is left is theirs. On top of that, if that borrower put down a down payment, they're less likely to walk away from the equity that they've built up over time, as well as what they put in with that down payment. Investing in notes is great for landlords who are looking for the cash flow without the headaches of being a landlord. Landlords who become lenders can collect that monthly check that they're used to receiving in the form of rental checks, except without the maintenance and the tenant turnover. Another upside of having landlord experience is that the due diligence required for determining whether or not a property is a good rental translates well to the due diligence required for analyzing a property tied to a mortgage. Of course, you don't have to have any landlord experience or any real estate experience before diving into notes. You can buy or originate a note today and be a note investor without ever owning a single door or unit. It's exactly what I did. Now, people often ask me how to start investing in real estate, and without fail, one of my first few questions to ask them is whether or not they want to be a passive or active investor. This distinction is important because it helps me understand what their investing goals are. Well, with notes, you don't have to be either one. You can be an active investor or a passive investor and still collect the holy grail of investing: passive income. The goal is to invest our money into assets that put our money to work. The money works while we do whatever the hell we want, and that's the power of passive income. This, of course, is pertaining to performing notes, which is when the borrower is paying their mortgage. When they're paying, all you have to do is sit back, collect the principal and interest payments. When we talk about risk, I'm sure we can all agree that there's risk in every asset class. I think that performing notes, when bought right, are some of the lowest risk assets out there. Of course, this is just my opinion. If you disagree, please reach out to me, Kevin@notenuggets.com. I'd love to converse about it, maybe bring you on the show. We could just have a chat about it. With any mortgage note, you are secured by the property. If the borrower defaults, your investment is protected by the value of the home the borrower owns. When I mentioned buying right, I was referring to making sure that there was enough equity in the home to protect your investment and ideally, of course, make a profit. So if the borrower stops paying for whatever reason, and you have to take legal action to get the property back and pay a realtor for selling the home and pay for closing costs, you need enough equity in the property to cover your investments and then some. The reason I say performing notes have a low risk is because there's multiple ways to exit the note. With multiple exits, there are multiple ways to mitigate your risk. The biggest risk, of course, with performing notes is that it can turn to a non-performing note at any time. With the borrower not paying their mortgage, you'd lose your cash flow. But as I mentioned, there's equity in the property with the assumption that you bought the note right. The equity can be leveraged to help modify the loan to more favorable terms for the borrower so you can keep that borrower in their home and then get them reperforming again so that you can collect that cash flow. The reason I say the equity can be leveraged to help modify the loan is if somebody's built up a ton of equity, they may not want to walk away if you can help them achieve a win-win solution. However, with enough equity, you can also turn a non-performing note into a home run. So if you're risk averse and you want to know that there's multiple layers of protection, then notes could be a great fit for you. Well, we've talked about multiple perspectives for people who notes would be a great fit for. Let's talk about who notes would not be a good fit for. One of the advantages of investing in real estate are tax advantages. With single-family homes or apartment buildings, for example, investors are offered certain tax breaks that can decrease their overall tax burden. Unfortunately, with notes, there's no escaping the taxes if you're buying notes with a checking or savings account. You will get taxed on the interest you collect, and it will be taxed as ordinary income. So if you're a high income earner, chances are you're also a high taxed earner too. And adding note interest to your tax situation probably does not help your overall tax burden, like investing in real properties can. Here's a disclaimer though, if you're interested in investing in notes and you want to know exactly how it'll affect your tax situation, please consult with your CPA. I'm not a CPA and would definitely not try to answer that for you. That being said, there is one way to avoid the taxes of notes, and that's to do it in a self-directed retirement account like a self-directed IRA, a solo 401k, or a SEP IRA. If the aforementioned accounts are Roth accounts, then any gains you make from your note portfolio are tax-free. So there is a way that you can do it, but you have to do it through those accounts. So you're not really collecting that cash flow per se, where you can help fund your lifestyle, but it is a way to create wealth in that nest egg of yours. So we've covered a lot this episode, and while we've done that, here's a TLDR for you. If you're an investor who doesn't want to be a landlord, is tired of dealing with landlord headaches, want passive income, and are risk averse, notes can be a great fit for your investor identity. However, if you're a high income earner looking for a tax break, notes might not be a fit for you. At the end of the day, it really depends on your investor identity, what you're comfortable with, what you like, how much time you have to dedicate, how much money that you have to use to invest. All of those things are things to consider when you're deciding on which asset classes. I just wanted to provide you with a particular set of perspectives that can help somebody navigate through whether or not notes are a good fit for them. So if you think notes are a good fit for you, or if you're just curious to learn more about how to create cash flow and generate wealth with other people's debt, let's have a chat. Shoot me an email at kevin@notenuggets.com or book a time directly on my calendar at notenuggets.com/contact. Until next time, everybody, thank you.
Thank you for tuning in to this week's episode of the Note Nuggets podcast. Be sure to subscribe to the show to get access to additional weekly value nuggets and get notified with episode updates. To subscribe, all you have to do is head over to subscribe.notenuggets.com. If you have any questions about this episode or note investing, book a time on Kevin's calendar at contact.notenuggets.com. We'll see you next week with another note nugget to add to your tool belt.